Hi there, I'm Paul Bagnall. Welcome to Market Call today on BNN Bloomberg. Andrew Moffs is on the show. He's Senior VP at Vision Capital. He'll take your questions on real estate securities. So get ready to give us a call. In fact, pick up your phone right now and do so. 1-855-326-6266 is the phone number. And you can also email us at marketcall@bnnbloomberg.ca. So we'll get to your questions with to Andrew Moffs in the second segment of our show. This is the first segment, and we'll welcome Andrew to the show and get his take on the current market environment for real estate stocks, real estate investment trusts in particular. Andrew, welcome to the show. You say you believe that we're in the fairly early stages now of a lengthy recovery in real estate investment trusts. Why?
We are finally at the precipice. It's finally actually occurred. We've seen the U.S. Federal Reserve cut interest rates. We've seen the Bank of Canada obviously cut interest rates a couple of times. Our research shows, on average, from the beginning of the easing cycle for the U.S. Federal Reserve, real estate stocks outperform. Over a period of 2 years, we've seen real estate stocks on average go up 20%. Over a period of 3 years, 30%. And you couple that with what is one of the most underweight we've seen generalists to the publicly traded real estate sector in history. We think that's a pretty compelling setup at a time where, of course, you have to look at different property sector by property sector. The fundamentals are quite good. So we think the setup is quite good, both sides of the border, for real estate stocks generally.
Lower interest rates benefit real estate entities in several different ways and affect the way the market looks at real estate investment trusts is in several different ways as well. Give us a detailed breakdown of the different ways that lower rates can affect the real estate market and real estate securities.
Yeah, so we like to think of it in two different ways, two sides of the balance sheet. First, on the leasing side, on the operations side, if you think about it, ever since interest rates went higher beginning in 2022, you've seen a slowdown in decision-making by tenants. So whether it's leasing an office building, leasing more space, or renewing a lease in an industrial warehouse, decisions have just taken longer as CFOs are not keen to put more capital to work when they don't really know what their cost of capital is. It's a lot easier today to make that decision. On the other side of the balance sheet, on the liability side, obviously rates coming down make it cheaper to access capital. Firstly, lower interest costs, it's an obvious thought. But the availability of credit has improved, as well as the thought that transactions should pick up. Now that people can underwrite assets more effectively, it's now easier for transactions to occur, and that pickup in activity will help give price discovery, because really what we've seen are frozen transaction markets. The public markets, because they trade every day, discounted the future. And in our view, overly discounted what would happen to property prices when interest rates went higher. Now that we're finally seeing transactions occur, price discovery is happening, and we think that spread is far too wide, and there should be a catch-up trade, and we've seen it begin, that publicly traded real estate should converge up to the price where private real estate will ultimately settle.
Andrew Moffs is our guest. He's an expert in real estate securities, real estate investment trust in particular, and he'll begin taking your questions right after this. Here again is the contact information.